India is building an economic engine projected to be worth 143 trillion rupees. Today, we're going to pop the hood and see exactly what makes it run. It really is the question on everyone's mind, isn't it? We all see India surging, but what are the actual gears turning this massive machine? Well, we're about to break it all down. So, let's start with the headline number. S&P Global thinks India's economy is going to grow at an average of 6.7% a year, all the way through 2031. Now, to put that in perspective, that's more than double the projected growth for China and nearly triple that of the United States. This kind of pace, well, it sets the stage for everything else we're about to talk about.
All right, here's our game plan. We'll kick off with the big picture of India's economic climb. Then, we'll get into the massive investment strategy that's fueling it. After that, we'll dive into the nitty-gritty rules of project finance. And finally, we'll see it all in action with a really fascinating case study from the defense sector.
First things first, India isn't just a fast-growing economy anymore. No, it's on a very clear trajectory to becoming a true global economic powerhouse.
I mean, the speed is just remarkable. Just last fiscal year, the economy grew at a blistering 8.2%, and that momentum is expected to carry right on through, putting India on track to overtake both Japan and Germany and become the world's third largest economy by the end of this decade.
So, how in the world do you fuel that kind of growth? Well, it takes a truly unprecedented amount of capital investment, which, you guessed it, brings us to our second section.
Just look at this number. 143 lakh crore rupees. Crystal estimates that's how much India will spend on infrastructure by 2030. That's about 1.7 trillion US dollars. But here's the kicker. This is more than double the amount spent in the previous 7 years combined. We're talking about a historic, once-in-a-generation level of investment.
But when you're talking about that much capital, a huge question comes up. What's the smartest way to actually invest it? It's not just about spending money, it's about spending it right.
And that leads us to a classic economic debate. Should the government take the lead, using public funds to build out the nation's foundation? Or should it step back and create the conditions for private capital to drive growth, which could bring more efficiency and innovation to the table?
You know, it's a really delicate balance. Public investment is absolutely essential. It builds the roads, the ports, the grids that the private sector needs to even function. But if the government borrows too much to fund those projects, it can soak up all the available capital, basically pushing private investors out of the market.
This has a name. It's the classic crowding out effect. Think of it like this. There's a limited pool of investment money out there. If the government cannonballs into the pool with massive spending, there's just less water or money for private companies. That competition for funds can drive up the cost of borrowing for everyone, making private projects way less profitable, maybe even impossible. It's a fundamental tension that policymakers in India have to manage constantly.
An investment of 143 lakh crore rupees doesn't just happen on a whim. It needs a sophisticated, really robust rulebook to manage all that money, the timelines, and of course the immense risks involved. And the architect of this financial framework is the Reserve Bank of India, the RBI. They're the ones who set the standardized rules for how these huge, multi-year projects get funded and managed, making sure the whole financial system stays stable.
The RBI takes these incredibly complex projects and simplifies them by breaking them down into three distinct phases. First, you've got the design phase. That's all the planning and approvals. Then comes the construction phase, the actual building. And finally, the operational phase, where the project starts making money and paying back its loans. It's a logical flow that brings some much-needed order to the chaos.
Now, this table might look a little dry, but it shows something really clever, how the RBI manages risk using what are called provisioning rules. Basically, for every loan a bank gives out for a project, they have to set aside a certain percentage of cash as a safety cushion. And notice this, the percentage is higher during the riskier construction phase, and then it drops once the project is up and running. It's a smart way to bake financial stability right into the system from the very beginning. Okay, so we've covered the macroeconomy and the regulatory framework. Now let's zoom in and see how these rules actually play out in a really high-stakes sector, India's defense industry.
So what in the world is a defense offset? It's actually a really powerful policy tool. In simple terms, if a foreign company, say from Europe or the US, wins a huge defense contract in India, they are legally required to invest a chunk of that money back into India's own local defense industry. The whole point is to build up India's domestic manufacturing and tech skills.
But actually complying with this policy? Oh, it is anything but simple. This isn't just writing a check. It is a meticulous, multi-year journey. As you can see, this 5-step process involves everything from strategy and approvals to finding local partners and getting everything verified. The whole thing can often take up to a decade to complete.
And because it's so complex, the risks of getting it wrong are enormous. Companies can make all kinds of costly mistakes, from picking the wrong local partner to simple paperwork errors that end up triggering audit failures. Mismanaging this process can lead to penalties in the millions of dollars.
But on the flip side, the rewards for getting it right are just as massive. This quote from a European defense company shows how navigating these rules effectively can lead to huge savings. By understanding the system of multipliers, where certain types of investments are worth more credit, they save $12 million. It just goes to show how high the stakes really are.
So, there you have it. We've gone from a massive nation-level growth projection of 6.7% all the way down to a single contract detail that saved one company $12 million. And that right there is the story of India's economy today. Massive, ambitious investment, all guided by a very complex and intricate set of rules.
Which leaves us with one final crucial question. Is this highly regulated, rule-based approach the secret sauce for building a sustainable economic superpower? Or could this very complexity one day become a bottleneck that actually slows the whole engine down?